inflation, Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best protection, the best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate. And the best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting. In the United States, the value of the dollar since I was born has declined by 94% to 6 cents. So inflation is a very cruel tax on people who believe in fixed dollars, but things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints. Yeah, it's enormously important to have the right heroes in life, and then it's enormously important that they never let you down. And I've been unbelievably fortunate in having those heroes, perhaps a dozen or so, led by my father and my first wife. They had a huge impact on me, but a number of other people have as well. And never in my life have I felt I was let down by them. I tell the students, the most important job they have for most of them is going to be the teacher of their children. And you start out as your children's hero. You don't get a second chance at living that role out. That child looks to you and forms its opinion of the world, its attitude, its behavior, starting with what they see in you. And I had enormous good fortune in that respect. I had, in the investing world, I had Ben Graham, I had my partner Charlie Munger, who taught me all kinds of things. There's several members of our board of directors that have had a huge influence on my life. So it is important to have the right heroes and select them with care. But when you find them, you will be a better person if you look at the qualities in them that you admire, and then you say, why can't I have these same qualities? I mean, that's the beauty of wonderful heroes, is that you get to see in action behavior that inspires you, and then you have to ask yourself the question, why can't I behave in a similar manner? And you will be a better person because of that. My wife reminds me. I was lucky enough to be wired a certain way. I mean, if you're lucky, you're lucky. I mean, if I've been born with the right adenoids or something, maybe I could have been a great singer, but I wouldn't have deserved any credit for that either. There's a lot of luck in life, and I've had it. So I don't feel guilty about it in the least, but I do feel appreciative. I was born into a very fortunate country. I was male when, if I'd been female, I wouldn't have had the same opportunity. I was white when, if I'd been black, I wouldn't have had the same opportunity. I had, in particular, a father who gave me unconditional love, throughout my life. He didn't give me unconditional approval, and I gave him plenty of reasons to withhold unconditional approval. But I have done what I was sort of cut out to do, and I've been lucky enough to be able to work at something that I've loved all my life. I sold shirts for J.C. Penney when I was about 17, and I stood on my feet all day and tried to sell people a $3.98 shirt instead of a $2.98 shirt when they came in. That wasn't that much fun, you know. So I have gotten to do things that are fun, you know. And I should be appreciative, and I'm not ashamed of it, but I'm not enormously proud of it either. I mean, it's just the way it was the hand that life dealt me, and I got dealt a very good hand.
I read an article that you wrote, I think, in 1977. The world has changed since then, so I want to get a sense of whether you still believe that the 5 things that you had then spoken about in terms of improving earnings stand true today. You said then that companies should be doing one of 5 things: hiking turnover, cheaper leverage, more leverage, lower income taxes, wider operating margins on sales. What would you now say to companies who are looking at bettering their return on equity?
I do look at those qualities in terms of businesses, and when I look at something like a Coca-Cola, which has been around since 1886, I say to myself, you know, they are now selling 1.6 billion 8-ounce servings of Coca-Cola products every day throughout the world. Everybody in this room has something in their mind about Coca-Cola, and I hope it's good, incidentally. And certainly, what are the chances that Coca-Cola will be selling more products 5 years from now or 10 years from now than presently? I would say it's almost a certainty. I mean, there will be more people, they will have more purchasing power. This product is a huge bargain. This product sells, if you buy it on weekend specials like I do, this product sells at about twice the price that it sold at 100 years ago. There aren't many products like that. The cost of this represents, for the average person, maybe a minute or two of their earning power, and it provides a moment of refreshment and, you know, happy memories, all kinds of things. So will they be selling more Coca-Cola a few years from now than they are now? Almost certainly, are Coca-Cola products. Able to price their product so as to counteract the effects of inflation and so on, sure. You know, so it's a pretty simple type of evaluation. You know, I can't look at some new idea. People send me these big envelopes, you know, filled with 200 pages of diagrams about some new product or process. I don't have the faintest idea what's going on in those things. But I can understand this. You know, I can understand chewing gum. You know, I mean, I've got a pretty big mind here. I got my mind around chewing gum years ago. And I stick with products where I think I can really see what's likely to happen over 5 or 10 or 20 years. And then those variables that we talk about in terms of return on equity enter into my calculations. But the important thing is to be in the right business and with the right people. And if you're in the right business, you don't go crazy in terms of what you pay for it. It's just like my buying that farm. I didn't go crazy in terms of what I paid for the farm. I had an honest guy running it, happened to be my son. And you know, now corn is selling, you know, for well over twice the price it was in the mid-'80s. Soybeans are selling at 3 times the price. So the farm is worth more money than before. And over the years, it's just kept delivering a check to me every year. That's what investment is about, and is really looking at the future income potential of a business and comparing it to what you have to lay out now to get that income potential, and that's investment. And I think that when you get into buying something where you're just betting on whether people will pay a little more for it next year, when it doesn't produce anything, there's nothing illegal about it. It's not illegal, it's not immoral, and it probably isn't financially fattening either. But you're betting on really investor attitudes or speculators' attitudes rather than betting on the asset itself.
So what attracts you to that can of Coke? Is it the taste or the fact that you've bought a major share into the company?
No, I don't want you to think of me as someone who would be up here drinking Coca-Cola because I had a financial interest in it. I mean, who would do that? Be sure you get this. We get the profits. We own about almost 9% of the company, so we get the profits on 1 out of every 11 cans So if you have any of this out there, just open the can. I don't care whether you drink it or pour it on your neighbor. But just be sure you open the can. No, I'll make a confession here. You'd nail me on it anyway if I misled you. I drank Pepsi for a long time. And the reason I drank Pepsi was that when I was a kid, Pepsi came in a 12-ounce bottle for a nickel, and Coke came in a 6.5-ounce bottle for a nickel. And you probably have gained enough insight into my personality by this point that you would understand why I chose Pepsi. And then Pepsi for a long time, it's a very interesting story because it's very hard to change the personality of a product in the consumer field. I mean, it's very dangerous to be, selling a product with one promise made through advertising and so on, and then shift gears. Pepsi did that successfully. Pepsi always was twice as much for a nickel too was their slogan. In the 1930s, the number one jingle was Pepsi-Cola hits the spot, 12 full ounces, that's a lot, twice as much for a nickel too. Pepsi-Cola is the drink for you. Well, it was delivered somewhat more professionally than that. But it was sold on the basis that you were getting twice as much for a nickel. And then and that worked for a long time. It gave Pepsi a position, but it positioned it as a price product. And then they made the shift successfully, which was remarkable. Sometime after World War II, they decided instead of selling the cheaper product, they would do Pepsi for those who think young and all these different other ideas. And they successfully replaced, in the public's mind, a product that was offered based on price with one that was offered based on some other quality. And it was a remarkable marketing achievement, one of the great ones of all time. So when they went to where they were charging the same price as Coke, I had to go for the real thing at that point. That's a tougher question than when to buy. Originally, when I was working with tiny sums, I always had way more ideas than I had money. So I had a portfolio, very limited dollar amount, and I would find something that was more attractive, and which I felt I knew as much about, but was more attractive by a significant margin than something I held. So I would sell something I held to buy something more attractive, never to raise cash. And I was always selling things that were still cheap because it was a market where there were a lot of things that were cheap, and I was looking for the cheapest among things that I understood. Over the years, as more and more capital is accumulated for which I'm responsible, frequently money outruns ideas. I have more money than ideas. So now the only reason I would sell something would be if I lost confidence in the business or the management, or it became dramatically overpriced. And that doesn't happen very often. We work with large quantities of stocks, so it's not an easy in and out type proposition. Looking back, you can say that there are some things that I should have sold based on valuation that I didn't sell. There's certainly some things where I've made mistakes about the business, the future economics of the business, and there are a few cases where I've made mistakes about the quality or integrity of the management. But those are the reasons why you sell something. If we, during the panic in the fall of 2008, I committed to buy. I was already committed to help the Mars family buy Wrigley. That was $6.5 billion. I bought the Goldman preferred for $5 billion, and then General Electric came along and they wanted $3 billion. I wasn't comfortable committing $3 billion more at that time. We had the money, but I like to leave a big margin of safety. So as part of that same transaction, I sold, I think, roughly $1.5 billion or so of Johnson & Johnson stock. I wasn't selling it because I thought there was anything wrong with Johnson & Johnson. I just felt that the General Electric preferred was more attractive, and I didn't want to leave myself in a position where I wasn't comfortable with the cash position that I would have had if I hadn't have sold that. So that was a rare case where, even under current circumstances, I sold something that I regarded as still attractive, but to buy something even more attractive. That's not usually the case. Well, the financial crisis, the big lesson from the financial crisis for those who are in the investment world, and this applies whether you're in India or Germany or any place in the world, is that people occasionally go crazy, as a group. And you had the tulip mania, in the early 1600s in the Netherlands. People are capable. They love the idea of getting rich, and if they see their neighbor getting rich from doing something, and they think they're smarter than their neighbor, and he happens to be buying, in the United States, he happened to be buying single-family homes and borrowing the limit on them and refinancing them as he went along to sustain consumption, and then they see prices continue to rise, so they get this proof back from the market, they get this feedback. Eventually, the whole country goes crazy, and it's very hard to resist a craze. I mean, we had an internet craze 10 years earlier, and we will have them again. We had a uranium craze, back, when I was in my 20s. So that's going to happen periodically. Humans are susceptible to wanting to believe that, that something that's happened recently is going to continue and that they're going to get rich based on it. And particularly when it's gone on for some time. The 1920s, we had a somewhat similar phenomenon where people discovered common stocks for the first time, really, the American public. And originally it was a sound premise. American businesses are pretty good things to buy, but they're not pretty good things to buy at any price. And houses are pretty good things to buy. In fact, it makes sense for people to buy houses, but one they can afford and with payments they can make. But it doesn't make sense to start paying twice replacement value and borrowing 90-some% of it and lying about your income and all those sort of things that come along. It looks like it makes sense for a while because it does work, and then all of a sudden the music stops. It's a little like Cinderella with the ball, Cinderella with the ball, and she knew at midnight, it was all going to turn to pumpkins and mice. But it was so much fun. The music is good, and the boys look better, and the drinks flow, and you don't want to miss out on it. It's getting better all the time, so you think, I'm going to leave at 3 minutes to 12. But the trouble is there are no clocks on the wall. It doesn't tell you when it's 3 minutes to 12, and everybody else is thinking they're going to leave then. And then the music stops, and everything turns to pumpkins and mice. And investors have to be able to detach themselves from those emotionally and temperamentally from that tendency to go along with crowd behavior. Anytime you buy a stock, if you're going to buy 100 shares of Microsoft at 26, whatever it's selling for, and there are 8 or 9 billion shares out, that means you're going to pay $200 billion for the company. Now, you're only going to buy 100 shares, but I suggest that you get out a yellow pad and you write, I am buying the Microsoft company for $200 billion because. And if you can write a sensible essay on why it doesn't have to be very long, few lines will do. If you can say why it's sensible to buy the company for $200 billion, then you can say why it's sensible to buy 100 shares at 26. And if you can't say that, forget it, because all you're doing is betting on what some hunch somebody has or what somebody said that day on television or something of the sort. You are buying a business when you buy a share of stock, and you have to be right about the business to be right about the stock. And you're not going to be right because people agree with you. You're not going to be right because people disagree with you. You're not going to be right because somebody prestigiously that's in a prestigious position says that it's the thing to do. You're going to be right if you're right about the business. And that simple little activity will focus you on what you're really doing. When I bought that farm, I said, I am buying a farm in Burt County, Nebraska at $700 an acre because, and I put the because, I think it will produce so many bushels an acre of corn, so many bushels an acre of soybean, and I will need to pay the tenant farmer so much, I need to pay so much in taxes. When I get all through, I will have about $80 an acre coming in, and I'm paying a little less than $700 an acre, and that's fine. That's going to work if I'm right. And the same thing applies to stocks. The same thing applies to buying an apartment house and renting it out. You have to go through that discipline. Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and incidentally, I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities. And when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money. But there are compensations to that on the other side of the equation. The Korean stocks you mentioned that I looked at 6 or 7 years ago were companies where you could only put a small amount of money in. And I was sort of reliving my youth. Somebody sent me a handbook of Korean stocks and told me that the market was interesting. So one Sunday afternoon, I did leaf through a couple thousand pages of Korean stocks, and I was sort of reliving my youth. I mean, other people look through old Playboy magazines or something like that, but I looked through these old manuals of stocks, and I bought a number of stocks in small amounts from companies whose names I couldn't pronounce. But the stocks as a group were so cheap that you had to make money out of them. They were Graham-type stocks, and that's what I would be doing. I would be combing that sort of a list. Now, if I found a wonderful company that Graham wouldn't have bought, but I really was convinced about its future, I would have bought that also. Incidentally, I've written in the last annual report about Geico, and I bought that stock in 1951 when I had about $10,000. And Geico, I looked at because Benjamin Graham was the chairman of the company. But Geico was exactly the sort of stock that Graham wouldn't buy. I mean, it was selling way above book value and all of that. There was a certain irony in that, but I'm glad I did it. Well, the whole idea of investment is to lay out money to get more money back later on, right? And if you buy a farm or you buy an apartment house or you buy into a business, either one you own directly or one you own a piece of through stocks, you are buying into an asset that you expect to produce something later on. Now, if I buy a farm like I did 25 years ago in Nebraska, I bought a farm, 400 acres. I paid close to $700 an acre for it, and I looked to see how much it would get an estimate of how much corn it would produce per acre, how many soybeans, what I'd have to pay the tenant farmer, what the taxes would be, and I made an estimate of the income that I would receive from that farm. I didn't go out and get a quote on it, I didn't turn on the farm channel, every day to see whether it was raining or something and whether it was good for my farm. Instead, I looked at the farm itself as to what it would produce. That's what I do in terms of stocks. Now, there are other kinds of assets that don't produce anything, but you count on them becoming more attractive to people next year or the year after. You're looking to the price change rather than the output of the investment. That's a whole different game. I mean, if you buy, we'll say, art as an investment, and you pay $20 million for some painting, you don't look for the painting to produce anything. If you're looking at it as an investment, you just hope somebody else will like that painting even more a year from now or 2 years from now. You're betting on the price of the asset rather than the productivity of the asset. I like things where I look at the productivity of the asset. I've used this example before, but if you take all of the gold in the world that's ever been produced, it comes to about 165,000 metric tons. Some people get excited just talking about that sort of thing. But if you put that all together in a cube, you would have a cube that's about 67 feet on a side. So we can take something maybe about the length of this hall here and have a cube like that, and that would be all the gold in the world. That gold at present prices is selling for $7 trillion. So that cube is a $7 trillion asset. Now, all of the stock market in the United States, I don't know the exact figure now, might be 20 trillion. So would you rather have a third of all of the businesses that exist in the United States, or would you rather have that cube to look at? That cube, if you take all of the farmland in the United States, there's about 1 billion acres of farmland. That's a little over 1.5 million square miles, about half of the continental United States. If If you take all of the farmland in the United States, that billion acres, you add in 7 Exxon Mobils, and then leave yourself $1 trillion for kind of walking around incidentals, that would be the value of that cube. Now, would I rather have that cube, 67 feet on each side of gold, or would I rather have all the farmland in the United States plus 7 Exxon Mobils plus $1 trillion to stick in my pocket? I think that's kind of an easy decision. But people like gold. When they get afraid of money, terrified of money, they run to gold, and then they hope somebody will pay more for it next year, because it isn't going to produce anything. That cube is just going to sit there and stare at you, you know. And you can go, if you own it, you can go and you can fondle it, you know, and you can sit on top of it and do whatever makes you feel good. But it isn't going to deliver anything to you. Did I indicate a preference there? You don't need to be real smart to be an investor. We try to keep that among ourselves, we investors. But the truth, I've often told audiences in the United States that if you have 160 IQ, sell 30 points to somebody else, because you won't need it in investing. But what you do need, you need a reasonable intelligence, and you need a passion for the activity. I mean, to do anything well, you have to love it, I think. But the most important ingredient is temperament. You have to have the ability to form your own opinion, disregard the sentiment around you. You can't get excited because other people are excited, or depressed because other people are depressed. You have to have. Now, you shouldn't get excited just because they're depressed, or depressed just because they're excited. But you have to have an ability to look at facts and think about them, independent of the chatter you hear in the background. And I would say that's about 80% of investing. And if you have that, you will have these other qualities like patience. I'm not a gutsy investor. I mean, I just do things that are pretty simple and obvious. And I don't feel I have to get rich tomorrow or the next day or next week. I mean, if I've made a decision, in fact, the real test is this. If you're buying a stock, would you buy that stock if you knew they were going to close the stock exchange for a couple of years? Now, people buy farms all the time, and they don't get a quote on it the next day or the next week or the next month. They buy apartment houses, and they don't run out and get a quote a week later or a month later. They look to the apartment house itself, or they look to the farm itself in terms of what it produces to validate their investment decision. But when they buy a stock, they want to look at the price the next morning to see whether they made the right decision or not. And that's just foolish. I mean, if you bought into a private business, you would look to the business to see how it performed. If it earned more money year after year and could pay out a reasonable amount to you, you'd feel quite satisfied, and you wouldn't feel you had to get a quote every day. So if you're buying a stock, I mean, we're buying one stock now at the moment. And if the New York Stock Exchange closed tomorrow and stayed closed for a couple of years, I would feel fine with that stock, because I'm looking to the business itself and not to the stock. And that attitude, which was taught to me by a fellow named Benjamin Graham 60 years ago, is still it's the fundamental philosophy by which I operate. And if you have that approach, and you can ignore the enthusiasms and the wails of the crowd and all of that sort of thing, you're bound to do well in stocks. Investors have to be able to detach themselves from those emotionally and temperamentally from that tendency to go along with crowd behavior. I mean, anytime you buy a stock, if you're going to buy 100 shares of Microsoft at 26, whatever it's selling for, and there are 8 or 9 billion shares out, that means you're going to pay $200 billion for the company. Now, you're only going to buy 100 shares. But I suggest that you get out a yellow pad and you write, I am buying the Microsoft company for $200 billion because. And if you can write a sensible essay on why it doesn't have to be very long, few lines will do. If you can say why it's sensible to buy the company for $200 billion, then you can say why it's sensible to buy 100 shares at 26. And if you can't say that, forget it, because all you're doing is betting on what some hunch somebody has or what somebody said that day on television or something of the sort. You are buying a business when you buy a share of stock. And you have to be right about the business to be right about the stock. And you're not going to be right because people agree with you. You're not going to be right because people disagree with you. You're not going to be right because somebody prestigiously, that's in a prestigious position, says that it's the thing to do. You're going to be right if you're right about the business. That simple little activity will focus you on what you're really doing. When I bought that farm, I said, I am buying a farm in Burt County, Nebraska at $700 an acre because, and I put the because, I think it will produce so many bushels an acre of corn, so many bushels an acre of soybean, and I will need to pay the tenant farmer so much, I need to pay so much in taxes. When I get all through, I will have about $80 an acre coming in, and I'm paying a little less than $700 an acre, and that's fine. That's going to work if I'm right. And the same thing applies to stocks. The same thing applies to buying an apartment house and renting it out. You have to go through that discipline.